talking about retracements and reversals. Now, before you can actually start understanding retracements and reversals, you have to understand the basic movement of trends. Now, we have all types of classes in trends so you can learn the basis and how to draw trend lines, but ultimately, you have to understand how price moves. And price only can move in three directions. Price can move up in an uptrend, down in a downtrend, or sideways, or what we sometimes call congestion, or a sideways trend. That's it. Now, granted, price can jump all over the place because nobody can control price. But when we can find a defined uptrend or downtrend, we can take advantage of that. Now, we know that price doesn't move like this. Price moves like this. It's a set of peaks and valleys, highs and lows. It's sometimes called waves or cycles. But if we understand how price moves, we can then start evaluating it to see whether the trend is ending or if it's just taking a breath. And these are called retracements and reversals. So the ability to point out the difference between a retracement or a potential reversal is a great tool to add to your trading arsenal. Many inexperienced traders, along with some of the most experienced traders, still are unable to detect the difference between an asset retracement and a potential reversal. Now, a potential reversal is quite worrisome. Okay. If you're in the market and you see a reversal, you want to get out of the market. If you're thinking about entering the market and you see a reversal, you don't want to get in. But a retracement is a very healthy move in a trend. And understanding what a retracement is and being able to define that retracement will stop you from selling or exiting the market at the wrong time and will also help you get entry points. Because say hypothetically you entered somewhere around here. Okay, the market pushes up and eases back down. You panic because it's almost down to where you entered the market. So you exit the market. You made virtually nothing. You might have not even covered the spread. But you're panicking, but this is a retracement. And if you understood how to define this retracement, you would realize that's the healthy part of that uptrend, and that uptrend is going to continue. And if you hadn't panicked, you could have stayed in that market and ridden it all the way out to here. Okay. We get another retracement, which are what? They're simply the peaks and the valleys, the peaks and the valleys. Okay. Why do these occur? Okay. How do we understand why they're going to occur? Well, I'm going to share a presentation with you shortly, but it's really about human psychology. At some point, traders start pushing the market upward. Whatever caused them to start buying an asset, they start buying. But it takes a lot of work and a lot of energy to push a market higher. So what happens is the buyers start entering the market starts going up. More and more buyers are attracted to the market, and the price comes all the way up here. Now what happens is this guy who entered down here that started this rally says he's already put his target point. He's already made his target. For instance, he said this asset, when it hits 32, I got in at 28. I put my exit point already there. I'm happy. I made my $4 profit. So his trades close out. As his trades start closing, the market starts to ease ever slightly because most likely it started, they picked that point to exit their trade because that was a resistance level, support level, a known level where this asset probably doesn't push above at the moment, and you are all happy to take your profit. Now, also what's happening is all these buyers that were getting ready to enter the market are saying, you know what, this price is getting a little bit too high for us to enter the market, because we know this 32 level is a very difficult level for that asset. So they don't run away. They just move to the sidelines. So what happens is this asset, for a brief period, loses a bit of its momentum. Now, it starts to come down. At a certain point, those sellers who had sold, because they were closing their positions, they're all cleared out of the market. All those positions are closed. But the buyers haven't come back in the market. At some point, this price comes down low enough that these buyers have moved to the sidelines, say, okay, that's a good price because I'm willing to buy at 31. And they jump back in the market and they start pushing that asset back up, because fundamentally that asset is sound and should be traveling up. So for you, understanding this retracement will stop you from panicking and jumping out of the market. Also will give you, if you're not in the market, will give you an entry point to jump in the market at the best available price to ride out that uptrend. And these are retracements. Like I said, the healthy part of a trend. So a retracement is defined as a momentary reversal that occurs during a longer trend. Unlike reversals, retracements show a continuation of an opposing trend within the targeted asset's price action. As you can see in the picture to the right, there are a couple retracements that take place and occur throughout a prolonged period of time. Now, a reversal are temporary changes in an asset's trend that occur over a short period of time. Oftentimes, reversals can last minutes, hours, or days. It just depends on what time frame you are utilizing for your charting solution. Reversals are oftentimes drastic and do not represent a long continuation of an opposing trend. During the asset's price action, like seen in retracements. So now Wall Street is full of investment idioms, but perhaps none is so broadly quoted as cut your losses short and let your winners run. Well, understanding retracements and reversals does exactly that, because you'll let your winners run because you won't panic and jump out, but you'll cut your losses when you see a reversal. Now, of course, this is easier said than done. But how, in fact, is an investor to know whether an asset is merely retracing against an existing trend or if the trend is an outright reverse? Now, successful investing is a predication on knowing the answer to that question. Now, there are some I don't even know how to explain. There are some standard answers that you can give to determine whether an asset is reversing or reversing or retracing. Because I don't believe in most of them. I'm more concerned with watching price action, support, and resistance. But you can watch volume. Okay. Volume can give you a key to whether it's a slight retracement or a big sell-off and the traders are moving. So it's usually, if you have big blocks of trades, it could be a reversal because institutionals are selling. I don't know how, on paper, it sounds very true, but I don't know how well we can see that in a time period we're trading CFDs. Okay. Chart patterns. Few, if any, reversal patterns, usually limited to candles, to see a retracement. Reversals, there are several reversal patterns, usually chart tops, double tops, etc. Now, there are many patterns that will tell you a trend is weakening or a trend is losing its momentum. Okay. Sometimes you can say it's a retracement if there's been no change in fundamentals. There's been no major economic event, no speech, no Nothing going on that is affecting that asset. Whereas if there's a big change in the fundamentals, like today in the U.S. with retail sales falling very, very low, okay, that has an effect on the dollar, has an effect on stocks, has an effect on the indexes. So that was a fundamental change that would have probably led us to believe we were seeing a reversal. Now, you're only faced with three options. Okay. Your first choice is to hold throughout the sell-off, which could result in large losses if the retracement turns out to be a larger trend reversal. Two, you can sell and rebuy if the price recovers, which would definitely result in money wasted on commissions and spreads. Okay. This may also result in the missed opportunity if price recovers sharply. And then three is sell permanently, which could result in the missed opportunities if price recovers. In other words, let your winners run. So as I mentioned to you in here, okay, what happens is you have three choices. Okay. You can let it run, but what happens is if you're sitting tight and it's in a retracement, but it turns into a reversal, okay, and you're not fast enough to think, you could end up losing whatever profit you made and end up with losses. Okay. But a lot of traders will sit tight hoping that the price will recover at some point and they can get out with either a small loss or a small profit. Two would be to sell at some point here and just leave the market. Take your profit and be happy. And three is to understand that it's a retracement so that you let it run. But those are your only three options. But by not being able to properly identify what is happening and selecting the wrong option, like if you want to sell and rebuy, so in other words, you had predicted this price to move up to $39. You would enter the market, say $30. Okay, this was your profit target. But we got to this retracement, started falling down, and as it got down to this level, you got worrisome, and you sold. Okay. Well, you made $1 per share. Not so good when you were $3 in the money already. But you say, okay, you know what? I'm going to sell now because I'm not sure what's going to happen, and I'll rebuy if the market retraces itself. The fact is, the chances of you getting back in here are very slim. You'll end up getting back in here. So what happens is you lost everything between here. And if you get back in here, how far did you actually ride it? So you're losing your profit by selling, rebuying. Depending if you had commissions or spreads, you could end up, just cutting because each one becomes a double or triple trade. But there are only, like I said, three options open to you. So let me share with you a little presentation on retracements that maybe will explain this a little bit better. And then we'll go on talking about reversals. Now, Fibonacci retracement levels, or the Fibonacci retracement tool, is only one of the ways we look to determine if we're looking at a retracement. There are many ways, simple support and resistance, because what happens is if price is pushed up and it eases back down, it should stop falling at a support line. Also, remember trend lines. Trend lines are drawn in an uptrend underneath the price. Now, one of the rules of a trend line is that the price cannot break that trend line. So as price is moving up, it's continuing making higher highs. As it retraces, it forms lower highs, but that means it doesn't ever fall below the low that it had achieved earlier. Therefore, it stays above the trend line. So let's go look at a chart, a real live chart, and see if we can see this in our chart tonight. So here we have the Euro US dollar on a 15-minute chart. Now we can see we're just coming over a downtrend, and we see in the downtrend push, ease, push, ease, push, ease, push, ease, push. Then it eased. Now remember, this is just the exact opposite of an uptrend. But see what happens. It eased, and it came higher than its previous low. And at this point, you know you are no longer in a retracement. You now have a reversal. And the asset reversed. Now it's pushed and eased, pushed and eased, pushed and eased. So at this point, you don't want to be in the market. So if you had entered the market down here, you surely want to be out here. Now, you might have recovered some of your lost profit by not getting out towards the top. But you would have liked to have been able to ride this uptrend to here, or as it continues up here, being able to stay in that market and stay alive. But if you notice, this is what happens. Push, ease, push, ease. The more well-defined the trend is, the more likely it's going to follow the exact right patterns. Okay, but as you can see, push, ease, push, ease. Each one, now this is a downtrend, so each one of these, because in this case a retracement goes to the upside. Retracement, 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 reversal. So this is what it looks like in reality. And by being able to pick those, if you had entered the market somewhere up here in this downtrend, I'm just trying to get my markers off of here. There we go. Now, if you had entered the market somewhere here in this downtrend, or after the first reversal, and entered the market somewhere here, you would have liked to have been able to ride it all the way down to there. But if you would have panicked when it came down to here, and then the price shot up here and jumped out of the market, okay, you made virtually no money. If you would have let it ride, you could have gotten all the way down to here. You could have gotten all the way down to here. And each one of these you would have not, and these are classic retracements. I mean, they follow all the rules that you would have required to stay in the market. And that's a lot of profit you could have made on the euro. Same thing here when it reversed. Told you that that downtrend was over. You could have been looking for a buy opportunity and could have ridden it out to this level. Okay. Now, it's very rare that you get virtually no congestion. You get a strong downtrend and a strong uptrend, but we had virtually no congestion. Downtrend reversed into an uptrend. Being able to identify that is very good, but being able to pick this very low bottom here to exit or enter the market is virtually impossible. Okay. Actually, we have a term for that in the market. Hold on, I'm just trying to get my PowerPoint back up here. And we call it trying to catch a falling knife. So traders have an expression for attempting to pick a market top or bottom, and they call it trying to catch a falling knife. As the expression implies, it can be downright dangerous and is not normally recommended. Okay, but here is a method that may help lower your risk. Okay. Now, understanding that retracements are healthy, a market in general can become tired of moving in the same direction. It takes a lot of work and money to send an asset to higher highs. When the price gets too high, buying pressure runs out and the money dries up. When the demand dries up, price begins to fall and causes the chart to go south. This causes security to become more appealing to prospective buyers who believe the asset has potential to move higher but are waiting for a better opportunity. As the price becomes more appealing at a lower price, these new buyers step in, creating demand, and once again the price begins another leg up. So what I've just described is the classic retracement. Retracements are kind of easy to understand and they're easy to see. It's just the hardest thing is having to learn to believe in that trend and believe that these retracements are healthy parts of a trend so that you don't panic. But as you can see, that after the retracement, the asset was unable to push higher highs. And all of it becomes on making higher highs and higher lows. Because a retracement can turn into reversal when that asset is not able, when it comes out of the retracement, to hit a higher high. Okay. Or if it hits a lower high in an uptrend. That's the depth of the peaks and the valleys. Okay. Now, instead of the security rolled over and created a lower high is unhealthy, but is not the end of the bullish trend. It is possible that after setting a lower high, the asset could retrace again, never setting a lower low, and then push above the previous high to a higher high. Because that's what you have to do, is you have to keep stepping up those steps. In this case, we would want to look at volume. Because as we reach that lower high, but you don't see selling volume, okay, and volume's low, that's not a bad thing. If we saw that the price couldn't reach that higher high and we saw selling volume increasing, that means the traders are getting out of the market or selling. Okay. So reversals are defined as a change in the overall trend of price. When an uptrend switches to a downtrend, a reversal occurs. When a downtrend switches to an uptrend, a reversal occurs. Well, that sounds pretty easy, doesn't it? Well, most of the time it's not so clean to see. And a lot of times the market will move into tons of congestion and a totally undecisiveness because it doesn't look like the asset when we were looking at the euro US dollar on the live chart, or we're looking at this mock chart, which looks almost the same. Assets don't usually come to a reversal point and then fall straight down. Come on, that's how we all wish the markets were. But that's very rare. Usually you'll get into a whole bunch of congestion as it moves up until the buyers decide whether they want to move that price up or let it reverse. So remember, when faced with the possible retracement reversal, you only have the same three options. If you're in a position, you could hold. You could close your position and re-enter when the price moves back, or you could permanently close. So because reversals can happen at any time, choosing the best option isn't always that easy. Now, if you have a trading plan, and built in your trading plan and your risk management were your own personal rules of how far you would let an asset retrace, like if you said in a minute it doesn't make, it goes below the previous low, I close my position. Or if it falls down in a retracement and it goes through a support line, I close. Okay. So if you have your own rules as to how you're going to make that decision when, that will suit you best. So the most popular tools used to do this are Fibonacci retracements, pivot point support and resistance, trend line support and resistance, chart patterns. Because usually when you're going into a retracement, you'll see it in a chart pattern, double tops, double bottoms. You'll see it in channels. You see it in wedges. You'll see it in triangles. A break of the trend line, support and resistance. And we talked about that. When the price falls through that trend line, that means that lower high is making not staying up, making a higher low. It's not making a higher low. It's making actually a lower low, and it's broken the trend line. So we want to get out. The next is support and resistance lines. Whether they're from pivot points, eyeballing, or swing highs and swing lows, if you have all of your support and resistance lines on your chart and you see it break those, okay, and not bounce off like you'd expect, okay, that would be a route to exit the market. But the Fibonacci retracement tool are an excellent tool for calculating the scope of the retracement. They are most widely used in Forex, but also used in the stock market and the commodities market and for CFD trading and crypto. To use them, simply use the Fibonacci retracement tool to draw a line from the top to the bottom of the latest impulse wave. Fibonacci retracements are excellent tools for calculating the scope. In most cases, their prices will retrace around the 38.5 level, 50% level, or the 68.2 level. If the price moves below these levels, then a reversal may be forming. Pivot points levels are also commonly used when determining the scope of a retracement. So if we were to use our pivot point charts, they will give us resistance 1, 2, and 3 and support level 1, 2, and 3. And if we were to draw these on our charts and have them, we could expect price as it's falling to come down to that support level, and that support level should hold it. When it breaks right through, okay, then we can see something else happening. Here it broke down and came down to level 2. But this will give us forewarning of how the asset should be acting, because what should happen is, as price is retracing like it did here, it should come to that support level and bounce off it. That should help support the price as it moves back to its uptrend. Now, if you're not sure how to use pivot point levels or what they are, we have a complete class in support and resistance. And we do this once or twice a month, and we'll teach you the several different ways of finding support and resistance levels. We also have a whole class dedicated to the Fibonacci tool. Now, trend line support. Finally, if trend lines supporting a larger trend are broken on high volume, then a reversal is most likely in effect. Chart patterns and candlesticks are often used in conjunction with these trend lines to confirm reversals. So I'm going to share one more presentation with you, and then we're going to go on and talk about how we would use chart patterns or what chart patterns will show us reversal, like the head and shoulders. So remember, technical analysis is a study of historical price performance in an effort to predict future price performance. Price is the only accurate measure of investor sentiment. It is the intersection of supply and demand. Investor sentiment is at least and possibly a more important determinant of price than fundamental factors like earnings, revenue, profits, and economic reports. There are three important principles that govern technical analysis. First, price is not random. Second, price anticipates fundamental change. And third, the relationship between price and time is linear. This is why an asset price moves can be viewed in patterns on charts. Different strategies have varying degrees of success depending upon where the market is in a bigger time frame. Technical analysis of a strong uptrending market will show that basing patterns are frequently broken to the upside, forming a stair-step chart pattern. In other words, push and ease, push and ease. This is a strong chart pattern in a strong market. However, the same trader who continues to use this pattern without recognizing the market has now lost momentum and is in a basing phase will not have the same success. Traders find that breakouts do not carry as far and as many breakouts start to fail and become losses. Now, breakouts are when we see a chart pattern, and these chart patterns are formed by these peaks and valleys or these retracement levels. We can see here a formation of a triangle. What happens? We have push up, ease, push up, ease, push up, ease. But each one is becoming more and more shallow. And what's happening is the traders are getting pushed into the apex of this triangle. At some given point, they're going to break out upward or downward. Okay. Now, this is part of an uptrend move. So if they break out upward, it is a continuation pattern, and the trend will continue upward. If it breaks out downward, then we have the reversal. And this is one of the ways we would be looking at our retracement and reversals and using chart patterns, because the chart pattern itself doesn't really predict the direction of the breakout. It just helps us anticipate that breakout and see how to react when that breakout occurs. Now, symmetrical triangles are very popular. A symmetrical triangle occurs when two trend lines converge towards each other and signal only that a breakout is likely to occur, not the direction. Okay. Now, these triangles are formed by the trend lines drawn or the support and resistance lines drawn using the peaks and the valleys, which are forming the retracement levels. Now, we have an entire class on chart patterns to explain each one of these patterns so that you can learn how to use them and incorporate them in your trading and to see whether they are a reversal or a continuation pattern. For instance, head and shoulders is a pure reversal pattern. So as a trader, you need to be able to differentiate between reversements and reversals. Without this knowledge, you risk many things such as exiting too soon or missing opportunities, holding on to losing positions and losing money and wasting money. By combining technical analysis with some basic identification measures, you can protect yourself from these risks and put your trading capital to better use. So that's going to be it for tonight. Now remember, ETX is a regulated provider, and that we thank you very much for coming tonight. And remember, your funds are always at risk. Do not trade if you do not understand what you're doing. Understand the risks of leverage and how to calculate your loss and apply risk management. So thank you very much, and we'll talk to you again real soon. Good night now.